Andrew, do you think it's okay that the ECB seems to be being pushed around by the markets a little bit here today? There was huge anticipation coming into this meeting, and there was a little bit of concern that the ECB would disappoint. It didn't. Christine Lagarde came through with 600 billion, and she's projecting certainly further forward than many would have anticipated. Do you think that the ECB is worried about disappointing the market, or do you think that is a secondary concern right now?
Well, I think maybe that last question in the press conference was sort of going in that direction. President Lagarde we could say, got off to a bit of a shaky start with one of her earlier press conferences. But she did a good job today in reassuring the market and being very clear in her communication. And at the end of the day, though, those things are important, but even more important is the substance, the content of the measures announced. And when you add up all of those measures, it's pretty big. And I think that's really what is the main driving force behind the market action we see today.
And of course, you're talking about when she said it's not her goal to target spreads, referring to, say, the BTP Bund spread, and that made the markets pretty angry. But nonetheless, she did mention financial conditions, that they're too tight, etc. Do you have a read on what they want to see? They have to be looking at yields, they have to be looking at spreads and saying, okay, this is where we get into a safer place. What is that level?
Well, they are looking at, in many of their communications, this GDP-weighted government bond spread to the Ionia curve, which basically reduces all of the financial conditions, at least the component of them from as measured by government bond spreads, into one useful variable. Now, that in a way is an interim target. I would actually describe the ECB as practicing a form of loose yield curve control. It's looking at that variable and it's looking at the components that go into that variable, such as the Italian spreads. So the financial conditions are clearly on a part of the PEP. It essentially was born and set up to ease the big constraints that the financial markets were imposing on the transmission of monetary policy to begin with. Now they're starting to mix the words inflation into the description of what the PEP is there for. But I think in practice, think of it as a loose form of yield curve control that the Bank of Japan has successfully been implementing for a number of years.
So is it just a matter of time then until they start buying junk in some capacity?
That option does remain there. I mean, they have already entered that territory by allowing fallen angels to be part of the eligible collateral list for the refinancing operations, the TLTROs, the LTROs, etc. So in a sense, they've done the preparatory work. They did not confirm that fallen angels or just the outright high yield market will be part of the PEP going forward. And I'm guessing we won't know until we see the minutes, but I'm guessing that topic was discussed and it's an option that remains available for them to implement in the future if things turn south from here.